I'm going to talk about why I believe gold will and must go to all-time highs, explained using macroeconomics, supply and demand, and gold's relationship to the bond market. So to understand why I believe gold must continue going higher, we first need to understand one of the most important relationships affecting its price: interest rates. More importantly, real interest rates. A real interest rate is simply the return you're earning after accounting for inflation. So if you're earning 4% on your money, but inflation is 3%, your real return is only around 1%. Your money increased by 4%, but prices increased by 3%. So your purchasing power only increased by roughly 1%. And this becomes important when investors are deciding between something like government bonds and gold. If we looked at this graph, this shows us the relationship between gold prices and real interest rate yield. The real interest rate yield is represented in light blue, and the price of gold is represented by dark blue. As real interest rate yields or real interest rates are high, gold is low. As real interest rates are low, gold is high. There is a direct in proportion relationship between the two assets. This is very important, as we'll describe later on. So back to our example, imagine a government bond is paying 5% while inflation is 3%. That's roughly a 2% real return. Gold, on the other hand, doesn't pay any interest. So if I can earn a positive return above inflation from a relatively safe government bond, holding gold means giving up that potential income. That's what we mean by the opportunity cost of holding gold. Generally, the higher real interest rates become, the more attractive bonds become relative to gold. But now let's flip the situation. Imagine that bonds still pay 4%, but inflation is running at 5%. You're earning interest, but your real return is actually negative 1%. You might have more dollars at the end of the day, but those dollars have lost purchasing power. Suddenly, the fact that gold doesn't pay interest matters a lot less, because the real return available from bonds has fallen. This reduces the opportunity cost of holding gold and can make gold more attractive as a store of value. So the relationship is fairly simple. When real interest rates are high, investors can earn a stronger return above inflation from relatively safe bonds. That increases the opportunity cost of holding gold and can make gold less attractive. When real rates fall or become negative, that opportunity cost falls as well, which can make gold more attractive as a store of value. This doesn't mean real rates are the only things that determine the price of gold, but they are one of the key macroeconomic forces affecting investment demand for gold. So who is buying all this gold? One of the biggest buyers has been the central banks. In 2024, central banks purchased approximately 1,045 tons of gold, followed by another 863 tons in 2025, which was well above the long-term average of around 473 tons per year. And this demand is coming from countries around the world, including Poland, China, Kazakhstan, Brazil, and Turkey. But why are central banks buying so much gold? Central banks are responsible for helping manage a country's monetary and financial system, including its foreign exchange reserves. Historically, a large portion of these reserves have been held in US dollars and US government bonds because of their safety and liquidity. But governments don't necessarily want to rely too heavily on one currency or one government, and that's where gold becomes attractive. Gold isn't issued by another country, it can't be printed, and it doesn't depend on another government repaying you. So central banks can use gold to diversify their reserves, reduce their reliance on the US dollar, and protect against currency, inflation, and geopolitical risk. And importantly, these aren't necessarily short-term speculative purchases. They're strategic purchases made by some of the largest financial institutions in the world. So we know that central banks have been purchasing enormous amounts of gold. But before we get into why they are doing this, I think it's important to understand just how scarce gold actually is. Because saying central banks purchased 1,045 tons in 2024 and another 863 tons in 2025 doesn't really mean much unless we understand how much gold actually exists. So throughout all of human history, we have only mined around 220,000 tons of gold. Because gold is virtually indestructible, almost all the gold we have ever mined still exists somewhere today. If we took essentially all the gold ever mined, melted it down, and put it together, it would form a cube approximately 22.5 meters long by 22.5 meters wide by 22.5 meters high, which is roughly 4.5 Olympic-sized swimming pools. Of this, approximately 220,000 tons, 44% is held as jewelry, 21% is held in physical bars and coins, 18% is held by central banks and other financial institutions, 2% is held by physically backed gold ETFs, and the remaining 15% is held by investors or used in things such as technology and industry. So when we talk about central banks buying hundreds or even thousands of tons of gold every year, keep in mind that central banks already control approximately 18% of the gold ever mined in human history. But how much gold is there actually left to mine? There are predictions of approximately 55,000 to 64,000 tons of known gold reserves remaining around the world. A gold reserve means gold that we know exists underground and is currently considered economically viable to mine. If we use approximately 55,000 tons of reserves and compare that with the approximate 220,000 tons already mined, that gives us roughly 275,000 tons combined. So around 80% of the combined amount has already been mined. Now, this does not mean that only 20% of the world's gold is left. More deposits can be discovered, and gold that isn't economically viable to mine today may become viable in the future. But from an investment perspective, the important thing isn't simply how much gold exists underground. What matters is how quickly we can actually increase the available supply of gold. In 2025, the entire global gold mining industry produced only around 3,672 tons of new gold. Compare that to the approximately 220,000 tons already above ground. An entire year of global mining only increased the existing supply of gold by around 1.7%. And even if gold suddenly goes up significantly in price, mining companies can't simply decide to produce twice as much gold next year. A new gold deposit has to be discovered, explored, and proven. The mine needs to receive approval and financing. And then the entire mine needs to be constructed before it can actually begin producing gold. This process can take many years. So the important thing to remember here is the supply of gold is extremely difficult to increase quickly. And that's going to become very important when we compare it to something whose supply can increase much more easily, which is money. So why are central banks increasingly diversifying their reserves in gold? To understand that, we need to look at the scale of debt, particularly US government debt. Worldwide debt is approximately 350 trillion, while US federal debt has reached around 39 trillion, which is just more than 10% of that total amount. More than 10 trillion of US government debt also needs to be refinanced over the next 12 months. The important issue though isn't how much debt exists. It's what happens when older, cheaper debt matures and has to be replaced at higher interest rates. What this means is that the US government has borrowed trillions of dollars over many years by issuing government bonds. Eventually, those bonds reach maturity, meaning the money originally borrowed needs to be repaid. But the government doesn't simply have trillions of dollars sitting around waiting to repay all that debt. So as old debt matures, it can issue new debt to help replace or refinance the old debt. The problem is that a lot of old government debt was issued when interest rates were much lower. So if that debt now needs to be replaced with new bonds paying higher interest rates, the amount of interest the government has to pay can become significantly larger. Think of it like refinancing a mortgage. Imagine you owe $500,000 at 2%. Ignoring repayments, that's roughly $10,000 a year in interest. If you refinance that same $500,000 at now 5%, that debt hasn't changed, but the annual interest cost rises to roughly $25,000 a year. The same basic problem applies to government debt, except the numbers are measured in trillions of dollars. So what can a highly indebted government actually do? Broadly, it can reduce spending, increase taxes, default, or allow inflation and easier monetary conditions to reduce the real burden of its debt over time. There is no painless option. Large spending cuts and tax increases can be politically and economically difficult, while defaulting would have enormous consequences. This is why high debt can create pressure over time towards easier monetary conditions. The preferred approach is to inflate your way out of debt. What does it mean to inflate away debt? Imagine someone borrowed $100,000 decades ago. They could still owe that same $100,000 today. But over those decades, wages, prices, and asset values have risen significantly. The debt hasn't disappeared, but it has become smaller relative to the income and economic activity available to service it. The same principle can apply to government debt. Inflation doesn't erase the debt, but it does reduce the real burden of that debt. And this is where gold comes back into the argument. The supply of money and liquidity can expand. Gold supply cannot respond in that same way. If more dollars enters the financial system over time, each dollar becomes less scarce and its purchasing power can weaken. So if the supply of dollars grows significantly faster than the supply of gold over long periods, more dollars may be required to purchase the same amount of gold, pushing the price of gold up. That explains why central banks may want to diversify part of their reserves into a scarce asset like gold. This brings us back to one of the most basic principles in economics, supply and demand. This is what a normal supply and demand graph looks like. On the left, we have price, and along the bottom we have quantity, how much is being bought and sold. The supply curve slopes upwards. Normally, as the price of something rises, producing it becomes more profitable, so businesses are willing to supply more. Demand, on the other hand, works in the opposite direction. As the price falls, consumers are generally willing to buy more, so demand increases. Where supply and demand meet is called the equilibrium. That intersection helps determine the market price and the quantity being bought and sold. An example of this is, imagine a cup of coffee sells for $5. At that price, cafes are willing to produce a certain amount and customers are willing to buy a certain amount. If the price rises to $10, selling coffee becomes more profitable. Cafes have an incentive to sell more. Maybe they stay open longer, hire another barista, or increase production. But at $10 a cup, fewer customers are willing to buy that coffee. Some people might decide that it's simply too expensive. The opposite happens if the price falls. Cafes have less incentive to produce as much, while more customers are willing to buy. Somewhere between those two extremes, supply and demand meet. The price where the amount of producers are willing to sell roughly matches the amount consumers are willing to buy. But gold is different. Gold miners cannot respond to a higher price nearly as quickly as producers in many other industries. A new gold deposit has to be discovered, explored, and proven. The project then needs approvals, financing, and construction before production can begin. That process can take many years. Existing mines also cannot simply decide to double production next year because the price of gold has risen. This is why the gold supply curve is much steeper. Economists describe this as relatively inelastic supply. In simple terms, even when the price rises significantly, the amount of additional gold supplied increases only slightly. Now we bring demand back into the picture. If more investors, central banks, and institutions want to buy gold, the demand curve shifts to the right from D1 to D2. At any given price, there are now more buyers wanting gold than before. The new equilibrium moves higher. But because gold supply curve is so steep, the quantity supplied only increases slightly from Q1 to Q2, while the price can increase much more significantly from P1 to P2. Normally, producers could respond to that higher price by rapidly increasing production. With gold, they cannot. So when demand rises against a supply base that can only grow slowly, much more of that adjustment has to come through the price. This is the key economic idea behind this part of the thesis. Increasing demand plus constrained supply creates upward pressure on the gold price. So where is all this demand coming from? We've already talked about central banks, but they're not the only part of the story. Investor demand increased approximately by 84%, with strong demand coming from gold-backed ETFs and physical gold investments. So we have demand increasing from multiple directions: central banks, ETFs, physical investors, and institutions. And this becomes particularly important because, as we established, gold supply cannot respond quickly to higher prices. So if we return to our supply and demand graph, increasing demand shifts the curve right from D1 to D2. Because gold supply curve is relatively inelastic, quantity only increases slightly from Q1 to Q2, while the price rises much more significantly from P1 to P2. So the basic argument is, increasing demand plus constrained supply equals upward pressure on price. And investment isn't the only source of demand for gold. Gold is also something we actually use, which brings us to technology. Gold has some extremely useful physical properties. It conducts electricity extremely well, it doesn't corrode, it remains reliable even when used in microscopic components, and it can continue working reliable for very long periods of time. Because of this, gold is used in things like processors, electrical connectors, sensors, bonding wires, and other essential electronic components. Industrial and technology sectors used well over 200 tons of gold in 2025, while the electronics industry absorbed only around 270 tons. And as our economy becomes increasingly dependent on advanced electronics, this creates another source of demand for gold. We're using more advanced processors, high-performance chips, sensors, computing infrastructure, power electronics, and electric vehicles push us even further. Electric vehicles account for approximately 22% of the global vehicle sales, and electrical vehicles require large amounts of sophisticated electronics, including sensors, processors, power electronics, and advanced electrical systems. Gold is used in these systems. So as electrification and advanced computing continues to grow, so does the need for many of the electronic components that use gold. Now, industrial demand isn't the largest part of the gold market. That's not really the point. The important thing is that we have another source of demand competing for a resource whose supply is extremely difficult to increase. So how does war affect gold? Well, during geopolitical uncertainty, investors and central banks may move money into safe haven assets like gold because gold isn't dependent on one particular government or currency. But war is also expensive. Governments may increase spending, borrowing, and debt to fund a conflict. Over time, this can contribute to inflation, easy monetary policies, or monetary expansion, potentially weakening the purchasing power of the currency. So war doesn't automatically make gold go up. What matters is how the conflict affects government spending, debt, inflation, currencies, and investor confidence. But there's another reason why geopolitics matter. The global financial system is becoming increasingly divided, and some countries are looking to reduce their dependence on the US dollar and Western financial system. Holding another country's currency or government bonds ultimately means relying on that country's financial system. During conflicts, foreign reserves can be sanctioned or frozen. Gold is different. Physical gold held domestically isn't issued by another government and can't be printed or directly controlled through another country's monetary policy. That's why gold can be attractive as a neutral reserve asset during periods of geopolitical uncertainty. And this brings everything we've discussed back into the basic economics of the gold market and my investment thesis. On one side, we have demand coming from central banks, individual investors, institutional investors, technology and electronics, electrification, and investors looking for protection against currency, inflation, and geopolitical risk. On the other side, we have supply that only grows around 1 to 2% per year, takes years to increase, can't simply respond immediately to high prices, and that is the fundamental economic imbalance that makes gold so attractive. Increasing demand plus constrained supply equals upward pressure on the gold price. But then we add another layer. If the US and other governments continue accumulating debt, monetary conditions eventually become easier, real interest rates decline, and the supply of currency continues increasing significantly than the supply of gold. Then gold doesn't necessarily have to become more valuable in absolute terms for its price in dollars to rise. The dollars themselves can also become worthless relative to gold. And that's why I ultimately believe gold will make new all-time highs. Not because the commodity itself is becoming dramatically more valuable, but because the monetary system it is measured against as a whole is becoming less valuable relative to gold.